G'day guys, it's Jake here. Nothing in this video is financial advice. Please do your own research when it comes to investing. Please be sure to check out my links below, including exchanges I use and social media content that I post. All right, let's go. All right, so the topic for this video, we're going over the economic data. It just came in, the annual non-farm payroll revisions, and we'll look at that, look at some rate cut probabilities from the Fed for September, and we finish off with some charts. So we're going to have unemployment rate and comparing it to the federal funds rate to see if rate cuts really are bearish or bullish, depending on the unemployment rate. So we'll get into that at the end of the video. So first up, here it is, the non-farm payroll and revision just came out. So minus 818,000 and previously was 187,000. So not looking good for the data. It's more jobs decrease, I believe, since 2009. So that's how bad revisions have gotten. And go back to 2009, and this is what the comparison is today's unemployment numbers for non-farm payrolls. We have an article from CNBC explaining it. Non-farm payroll growth revised down by 818,000. Labor Department says, okay, as part of proving the annual benchmark revisions to the non-farm payroll numbers, the Bureau of Labour Statistics said the actual job growth was nearly 30% less than initially reported. The revision to total payroll levels of minus 0.5%, the largest since 2009, which I just mentioned. At the sector level, the biggest downward revision came in professional and business services, where job growth was 358,000, less than initially reported. So it's just basically saying that the US economy created 818,000 fewer jobs than originally reported in a 12-month period from March 2024, the Labor Department reported Wednesday. So, yeah, so 30% less, so 2.9 from April 2023 through to March of this year. So that's what the calculations were made. And to 2009, the biggest revisions, which is quite staggering, it's quite bad. It's not good that they're revising them down to make them numbers that come out, the estimates, and they come really close to what the actual number is. And the actual numbers are low, which is not what you want to see in a growing economy, a stagnant economy, and a slowing economy, which is what we're just about to see, I reckon, from that. So that is that number, and probably won't read through all this. So the Federal Reserve officials nevertheless are watching the job situation closely and expected to approve their first interest rate cut in 4 years when they meet in September. Chair Jerome Powell will deliver the much-anticipated policy speech Friday at the Fed's annual retreat at Jackson Hole, Wyoming. Okay, so that is that. And I do believe that his speech comes out in the morning, okay? So my time, midnight. So that comes out to see what really, it's just talking about their confidence in the numbers and whether they're prepared to cut. They won't say that. They won't confirm that at this speech. It's just a bunch of talking themselves up like the central bankers do. Okay, so that's what they usually do. So it's not going to be much of a speech. It's just going to be another, what do you call it, the jawboning. They just like to jawbone and just talk up the actions and calm the markets down and not freak anybody out. So that's the role of the Federal Reserve, okay? That's what they do, these crooked central bankers. We have CME Fed Watch Tool and the probabilities for September rate cut. So 24.5% chance of a 50 basis point cut, or a 75.5% chance of a 25 basis point cut. Okay, as you can see down here as well. And for the rest of the year, we'll have a quick look. Probabilities, okay, for the rest of the year. So that's that data, right? So that's that. And then we have another cut scheduled in November, which is very likely. And then for the end of the year, it's probable for another cut in December. Okay. So 3 rate cuts pretty well priced into the market. I think the market looks optimistic towards getting them because of the overly, 5.5% for too long since July last year. So it's been held up for quite a significant amount of time, and the banks, especially the private banks, will want to see them come down because their borrowing costs are more expensive, and they got to go and chase yield to try and make more than that. So it's not going to be sustainable for a long period of time. And I think they're screaming out for rate cuts. They want to see them drastically. And so small businesses to get loans for things, and just people with mortgages, car loans, and the rest of it. So that is what we want to happen. And whether they get a 50 or 25 base, 25 or 50, we'll have to wait and see. Okay. And I'll just do a quick chart analysis of the unemployment rate. And actually, I'll bring up the recessions because that will give us a bit more clear understanding of exactly when they occurred. Okay. And that is that. So you can see once the trend ribbon turns green and it spikes up, a nice breakout. Okay. It just marks a recession. This one here, it turned green, and then shortly after that, recession. In 2008, 2001, it went green, and shortly after that, recession. And we went green here, made a base, and then we started to shoot up. And then after that, sort of spike up, and uptrend really took off. 1990, recession. Okay. Again here, 1981, 1982, we shot up, and then boom. We had a stagnant period here in between, flat, but there was a recession prior, 1980, which was the same sort of thing. Okay, green trend ribbon and shoot up. Same thing here, go to the base, a nice push up, and then it turned green, and then boom, recession. In the mid-70s, and then 1969, 1970, we had green and a recession. Same thing as 1960, green, recession, 57, 58, green, recession, turned green, recession. Okay, in the early 50s and then the late 40s, recession, same thing occurred. Okay, so that's just how accurate it has been. Pretty accurate. Okay, that is that. And then I'll overlay the Fed funds rate. All right. So the interest rates make them always goes pink for some reason. Make them yellow. All right, it's cool. So we had a cut. Right, the Fed started cutting rates, and what happened? They started cut, and then in 2019, of course, before the pandemic, they were cutting for the bank repo facilities were in trouble. The private banks lending to each other, and the Fed had to step in and start stimulating that market because the overnight rate would just shut up like a rocket and went out of control. So they had to step in, and they cut. And then the recession didn't occur until the pandemic, and they slam rates right down. So this is right after the cuts happened in the Fed's fund rate, and that was at 2.5, and they dropped from all the way back down to basically zero. But it's not technically it's not zero, but it's close to zero, as you got here. It's 0.25, okay, percentage points. Yeah, so same as the 2008. Period. Same happened here, okay, in 2020, 2021. And then we had 2008 or 2007, they started cutting a little bit before, cutting, and then the recession occurred. So they already cut, right? And the unemployment rate took off, as you can see there. And then the recession occurred, and then boom, they slam rates down because the panic happened. This is a bit more, it's like a big shock slam. Obviously, they did coincide, the unemployment rate and the cuts, but it was just a black swan event. It came out of nowhere, like just took everyone by surprise. And you got 2001, okay, recession, and they already started cutting, and then the unemployment rate started to shoot up, and then boom, recession. And they both sort of cross each other, and you can see how Fed funds rate works. They drop rates down to a low enough period where they see unemployment start to come down, and then they start raising again, okay. So here into the great financial crisis, and then steadily it went down, and then it started to shoot up. They react. Okay, that's what the Fed do. The jobs numbers, very, very crucial. So that was dot-com bubble. We had the 1990 crash, and the real estate crash really it was, and the Fed already started cutting. Okay, they cut, and they saw the unemployment start to shoot up and turn green. Well, they didn't see the green ribbon, but they did see it start to tick up nevertheless. And then recession occurred, and they slammed rates down as the unemployment rate took off. And you can see here, it peaked as the rates pretty much flattened, and then flat, and then the unemployment come down. So their tools worked back then really, really effectively. Okay, so that's that. And then we have this period here, the 1981, 1982, and the Fed really just slammed rates up, and they just cut aggressively down as unemployment just took off again. Okay, we had a flat stagnant period, and it shot up, it went down. And before this was 1980, as you could see, we had it start to sort of to form a base, it started to shoot up, and they were raising rates like crazy here to fight inflation. Was the ultimate mission there, and they slammed rates back down. Had to shoot them because the unemployment rate started to get out of control. So they had to pick their fight: unemployment rate or inflation. All right, so you had a pretty bad inflation there, and you can see what happened. Okay, as soon as they slammed rates down, unemployment rate topped, and it started to go down as rates steadily increased, but ultimately they went lower. Okay, so they didn't need to raise them much. Okay, then go back to 1973 to 1975. And the unemployment rate obviously started to form a base and shoot up. And the raising rates. Oh, crap, we better cut now. Cut. And that was a recession, of course. And then it just kept taking off. A bit late in that one, the Fed. I think this was the Burns era, before Volcker. Just before Volcker stepped in, I believe. Anyway, that's the Burns thing, the Federal Reserve Chairman. And then we had the recession in 1970, and then they had to cut rates in the yellow, and the unemployment rate was rising. So they responded to that. As you can see, one goes down, one goes up, and then eventually it worked. Okay, then eventually it came down because the cuts worked and stimulated the economy. It was a lagging effect, and it worked. So this is 1960. They had rates pretty elevated, 4% or so, and then they started to cut as the unemployment rate took off, and then they cut, and then we peaked unemployment, and then we just fell off a cliff, and that gave an excuse to raise rates even further, okay, to 5.5%, thereabouts, okay. Anyway, that is that, and then we have 1957, 58, same thing, had rates go high, raise, and they cut, and unemployment shot up. All right, just showing the same thing. The 50s, this doesn't go back, Fed funds doesn't go back far enough. But, yeah, it's probably a bit higher at this stage, and they cut to come back down to here, which found a peak, found a bottom in federal funds, yes, and the top in unemployment, and we came down, and that gave an excuse to raise rates, all right? But at the end of the day, it's see the correlation. It's sort of negatively correlated throughout the period of its history. Okay, so I just showed you those ones going from now period to then, how the Fed responds, and sometimes usually they cut before, but sometimes they're late. Okay, sometimes they're late to the party. Like this here, they slammed them up and they had to cut aggressively. They were late, it really took off, and they were a little bit late here, but they got, they sort of got in time, but the unemployment rate just shot out of control, all right? And they were late here in the mid-70s as they cut, and it just went parabolic. And they were slightly late here in 1970, but usually here, like head of the curve, okay? But sometimes they are, sometimes they're not. Depends on their mandates and what they see in the data. So that is that, okay? So that is the Fed funds rate and the unemployment rate. So I hope you enjoyed that video, just going over the economic data, which was the job revision numbers annual for non-farm payrolls. They came in at minus 818,000, which is ridiculously bad revisions downward. The worst since 2009. It's a great financial crisis. This is what the comparison is. And they sort of underplayed it. They released it, and there wasn't much people talking about it. It sort of slid under the rug, and obviously the news did mention it Because if they freak out people by mentioning how bad these job revisions are, then I think the people participating in the markets the big boys and that will start panic selling. But yeah, they just slid under the rug, hit it pretty much. They just released it without raving about it. And yeah, it's not good data at all. This is terrible data. And that's why we've been seeing estimates. Sometimes job numbers are beating estimates, the non-farm payrolls. And you think, why is that? Because they revise the numbers lower to make them look better. The analysts look better than actually reported. So what's reported is not good, and it's trending in the wrong direction. And unemployment rate is showing that as well. So that's really more prominent and more stronger indication for recession. Okay, so the federal funds rate and the unemployment rate, as I showed you on the chart, and compared the two, and when the Fed start cutting to obviously try and bring down unemployment, right? To fight unemployment, to bring it back up, the employment rate up. So more people employed, of course, and the unemployment rate shoots down eventually after a lag, after some consecutive rate cuts. Doesn't happen straight away, but it happens after a lag. And it shows you on the chart there how it really plays out. And also showed you the rate cut probabilities, how the 25 basis point cut is pretty much baked in the cake, and the 50 basis point is not. Very low chance there. And then there's chances for November and December are pretty high of a federal funds rate reduce. So that is the data. And I hope you enjoyed this video. Please smash the like, comment your thoughts below, subscribe to stay updated. Check out the links below, and I'll catch you next one. Cheers.